Hey everybody, back with another dividend analysis, and today we're going to be looking at Cisco Systems Inc. or CSCO. Going to be looking at Cisco because they are currently approaching the highs that they had reached before 2020, and we're going to look and see if they're currently something we want to look at or stay away from because of those new-ish highs. As usual, we'll start with the dividend yield. We can see they can currently pay a little over 2.5%. Decent for a tech company and doing better than the wide market, but nothing to write home about. But maybe they have that dividend really well supported. We'll find out. If we go back and look through the history, we can see that back in 2011 they were paying 6 cents a share, and they are currently paying 36 cents a share. So about 6 times what they paid 10 years ago. That's very nice, a lot of growth there. One thing to be a little careful of is how much the dividend has slowed. We could see that they had 3, 4, 5 cent raises over the past few years, but over the last 3 years we've only gotten 1 cent raises, so that dividend growth has slowed down significantly. Keep that in mind if you're looking at this, that there is dividend growth, but what you got 10 years ago you are not going to be getting this year. Just be careful with that. Next, let's take a peek at the numbers. We can see that they paid just over $6 billion in free cash flow last year. Quite a bit of money, but they are a very large company at nearly $250 billion. So let's go take a peek at the cash flow. We can start by seeing the cash flow growth, and we can see that over the last 10 years, as well as over the last 5 years, there's been some good growth. We have about a 40% increase over the last 10, and over the last 5, about a 10 to 12% increase, so not bad at all. Little up and down in the last 5 years, but they are finishing at about $14 billion, which is more than almost all of the previous 10 years. Very nice there. A lot of free cash flow growth. Dividend looks like that the increases are going along with that. Next, we can find out our percentage, our payout ratio of free cash flow, and we can see that we are currently at about 44% of the last 4 quarters free cash flow. Very nice. Under our ideal range. Even if they doubled their dividend, they would still have enough free cash flow to pay that dividend. No problems there. So even if this cash flow goes down a little bit, let's say they go back down to their like 12.5 billion numbers from a few years ago, they're still going to be able to easily pay the dividend that they currently have, even still raise it. No problems there. Good to see. Next, we can go look at the income. And we can see that income's a little over $10 billion, and if we do our calculations, we can see that they're paying out about 60% of their income as dividends. Not as good as their free cash flow, not under our ideal range of 50%, but under the acceptable range of 75%. So even if their income does drop a little back down to these high single digits, they're going to be able to pay that dividend without much of a problem. The one thing about their cash flow is it's a bit spotty. There was a big loss a few years ago, probably some kind of write-off here. They did have a $13 billion year in 2019, and they've also been very flat over the last roughly, what can we call that, 9 years about. So just be careful here. Their income isn't as increasing that much, so you're probably not going to see very large dividend increases. Those 1 cent increases seem like they're what they're going to be doing in the future, unless there's some big increase in income to go along with that free cash. So keep that in mind. So how are they making this income? How are they making this cash flow? Cisco provides networking hardware and software in the routing, the data center, and the wireless departments. Essentially, they're providing hardware and software to other companies to do those things that they do. What is interesting is that they are moving to subscription and recurring sales models more and more. They're trying to get more and more of their income, more of their revenue to come from recurring sales, like everyone is these days. So if you're really going to do a deep dive into this, you want to look and see where exactly their income is coming from, how much is one-time charges, whereas how much is recurring sales, because that might be able to drive that income up. If they're able to get a lot of recurring sales over time, you might see that income increase over time to go along with that. And, as inflation increases, as, the price of money increases, you might see that income start to jump up for those reasons as well. So just keep an eye on those things. So who is Cisco for? Should you be buying this? This is a tough one because it is a good company. The numbers aren't bad. It's very large. It's very stable. Its growth isn't amazing by any means. So it's really hard to say who this is for. We'll start from the income side. 2.5% is really low for income. This is going to be like the lowest of the low in an income portfolio. Any lower than this, and you're really just it's less of a dividend stock and more of a stock that happens to pay a dividend. So you're really not going to see this in many income portfolios from people who are income focused. On the dividend growth side, again, there is dividend growth here. I mean, over the last 10 years, 600% is nothing to laugh at, but it has been slowing down to that 1 penny per year. So if you're getting in now, you're not going to see the same kind of growth as if you would have gotten in 5-10 years ago. So should you be buying this? I'd really, at the current price, the current valuation, I'd really stay away from this outside of getting it in an ETF. The biggest reason is it's not a bad company by any means, but there are just better choices out there. If you're looking for dividend growth in the tech sector, you might go for something like Seagate, STX. You're going to get more growth for another large, very mature tech company. If you're looking for income potential, you might go for something like IBM, something that's similarly valued in the low 20 PEs, but is paying nearly twice the dividend. If you're looking for something that's a better value, if you're looking for a value investment, you might go for something like HP, because, half the PE, but paying the same dividend. So really, I would tend to stay away from this at its current valuation. For a dividend stock, it's just not what you'd want. Now, if you were lucky enough to get in at like when it was $35 during the crash, when it was about $33, if you were able to get in somewhere in here, then I'm not saying you should sell by any means, but just know that the price it's currently at, it is a bit overpriced. We can see the PE sitting around 23 for such a well-established company. I'd really want to get this for about, a half to 2/3 of what it's at if I want it for a dividend investment, because I want that yield. For a company of this size, I want a much larger yield. I want that kind of IBM, giving me 4.5% to 5%, because that's where I'm going to get my money as opposed to growth, because there's not a ton of growth here. It's just a little overpriced, so I'd just be careful. If you're looking at it, just keep that in mind. Not telling you shouldn't buy it, but just know what you're getting into, know what the other options are. I hope that helps, and thanks for watching.